Disclosed recording. Samsung CEO panic. 50M Oz shortage. COMEX empty. 5M. A recording that was never meant to go public. Samsung's CEO, speaking words that reveal a crisis most will never see coming. 50 million ounces. Gone. COMEX vaults. Nearly empty. Just 5 million left. While the world scrolls through their Samsung devices, unaware that the materials needed to build them are vanishing. This isn't about one company's problem. This is about what happens when the invisible foundation of modern commerce begins to crack, and the executives who see it first start to panic. Pause 2 seconds. Welcome to Financial Inspection. If you've lived long enough to remember when business news came from newspapers and not notifications, then you understand the value of information that actually matters, the kind that protects what you've built. We'd be honored if you'd subscribe and tell us, where in the world are you watching this from today? A recording surfaced in early 2025 that sent quiet shockwaves through executive boardrooms across 3 continents. It was not leaked by a whistleblower. It was not stolen by hackers. It was disclosed through channels that suggested someone, somewhere, wanted this information to reach the right people. The right people being those who understand what happens when the materials that power modern civilization begin to disappear. The voice on the recording belonged to Samsung's chief executive. The tone was measured, but the words carried weight. He spoke of a 50 million ounce shortage. He referenced COMEX inventories sitting at 5 million ounces. He used terms like critical supply disruption and unprecedented procurement challenges. These are not words executives use lightly. These are the phrases that appear in crisis management meetings, not quarterly earnings calls. Samsung is not a small company struggling with vendor relationships. It is one of the largest technology manufacturers on the planet. It produces smartphones, semiconductors, displays, batteries, and dozens of other products that define modern life. When Samsung's CEO expresses concern about material availability, it is not a minor supply chain hiccup. It is a signal that something fundamental has shifted in global commodity markets. The material in question is silver, industrial silver, the kind that goes into every electronic device, every solar panel, every advanced battery system, and every 5G infrastructure component being installed worldwide. Silver is not glamorous. It does not make headlines like oil or gold, but without it, the technology sector does not function. And Samsung needs it in quantities that most people cannot comprehend. 50 million ounces represents approximately 1,455 metric tons of silver. To put this in perspective, global silver mine production in 2024 was roughly 850 million ounces. Samsung's shortage alone represents nearly 6% of annual global production. This is not a rounding error. This is a structural problem. The recording mentioned COMEX, the commodity exchange in New York where silver futures are traded and physical silver can be delivered. COMEX serves as the backbone of price discovery for industrial metals in North America. When manufacturers need silver, they often look to COMEX registered inventories as a gauge of available supply. The recording stated that these inventories had fallen to 5 million ounces. 5 million ounces in COMEX vaults sounds like a large number until one understands the scale of industrial demand. Major manufacturers consume millions of ounces per quarter. When inventories drop to levels this low, it indicates that physical metal is being drawn down faster than it is being replenished. It suggests that industrial users are competing for limited supplies. It means the buffer between supply and demand has almost vanished. The business community should understand what this represents. Samsung is a sophisticated buyer with decades of procurement expertise, long-term supplier relationships, and financial resources that dwarf most corporations. If Samsung is struggling to secure 50 million ounces of silver, then smaller manufacturers are facing impossible conditions. If COMEX inventories are depleted to 5 million ounces, then the entire pricing mechanism for silver may be on the verge of dislocation. This is not speculation. This is what the recording conveyed. The disclosed conversation was not about hypothetical risks or distant future concerns. It was about present-day shortages affecting current production schedules. It was about a CEO trying to communicate to his team that the assumptions they had operated under for years were no longer valid. The question facing business leaders is straightforward. If one of the world's most powerful technology companies is experiencing material shortages of this magnitude, what does that mean for the broader economy? What does it mean for industries that depend on the same materials? What does it mean for pricing, for supply chains, for competitive positioning in markets where access to critical inputs determines who survives and who does not? The recording was not meant to cause panic. It was meant to force recognition. Recognition that the materials underpinning modern manufacturing are not infinite. Recognition that inventories can be depleted. Recognition that when shortages begin at this scale, the consequences extend far beyond a single company's balance sheet. This is where the story begins, with a recording, with 50 million ounces, with empty vaults, and with the uncomfortable realization that what seemed stable was never as secure as it appeared. Silver does not make noise when it disappears. There are no alarms that sound when mine production falls short. There are no emergency broadcasts when industrial stockpiles run thin. The metal simply becomes harder to find, harder to buy, and harder to secure at prices that were considered normal just months before. And by the time a CEO is speaking about a 50 million ounce shortage on a recorded call, the crisis has already been building for far longer than anyone outside those boardrooms realized. To understand how Samsung arrived at this point, one must trace backwards through a supply chain that spans continents and involves decisions made years in advance. Silver does not appear on demand. It comes from mines in Mexico, Peru, China, Australia, and Poland. It is often extracted as a byproduct of copper, lead, and zinc mining. This means that silver supply is not determined solely by silver demand. It is determined by the economic viability of mining other metals entirely. When copper prices fall, silver production falls with it, regardless of how desperately technology manufacturers need the metal. In 2020, global silver mine production was approximately 850 million ounces. By 2024, that figure had barely moved. Meanwhile, demand had exploded. The solar energy industry alone began consuming over 200 million ounces annually. Electric vehicle manufacturers required silver for battery systems and electrical components. The 5G infrastructure build-out across Asia, Europe, and North America created demand for millions of ounces in telecommunications hardware. And every smartphone, every laptop, every tablet required silver for circuitry and connections. Samsung sits at the center of this demand surge. The company manufactures over 250 million smartphones per year. Each device contains between half a gram to 1 gram of silver. That alone represents 125 to 250 million grams, or roughly 4 to 8 million ounces annually, just for smartphones. Add in Samsung's semiconductor production, display manufacturing, home appliances, and battery systems, and the company's total silver consumption easily exceeds 20 million ounces per year. Some industry analysts place it closer to 40 million ounces when all divisions are accounted for. So where did the 50 million ounce shortage come from? It came from a miscalculation, not Samsung's alone, but an industry-wide miscalculation about how quickly demand would grow and how slowly supply would respond. In 2021 and 2022, manufacturers operated under the assumption that silver would always be available at reasonable prices. They maintained lean inventories. They relied on just-in-time delivery. They prioritized capital efficiency over supply security. Then the cracks began to show. In 2023, several major silver mines faced production delays due to environmental regulations and community disputes. In early 2024, geopolitical tensions disrupted shipping routes for refined silver coming out of Asia. By mid-2024, technology manufacturers were quietly competing for the same limited supplies, driving spot prices higher while official exchange prices lagged behind reality. This created a two-tier market where those with existing supplier relationships paid one price, and those scrambling for new sources paid significantly more. Samsung's procurement team would have seen these warning signs. They would have attempted to lock in long-term supply contracts. They would have tried to build strategic reserves. But when an entire industry is doing the same thing simultaneously, there is not enough metal to go around. The 50 million ounce shortage represents the gap between what Samsung needs to maintain current production levels and what it can actually obtain from available sources. This is not a temporary disruption. This is a structural imbalance. Global silver demand in 2024 exceeded supply by an estimated 150 to 200 million ounces. That deficit was filled by above-ground stockpiles, exchange inventories, and secondary recycling. But those sources are finite. Once they are exhausted, manufacturers face a choice: reduce production, redesign products to use less silver, or pay whatever price is necessary to secure supply. Other manufacturers face identical pressures. Apple consumes millions of ounces for iPhones and MacBooks. Tesla requires silver for solar panels and vehicle electronics. Siemens, GE, and other industrial giants need silver for electrical components and renewable energy systems. They are all competing in the same depleted market. They are all discovering that the assumptions that guided procurement strategies for the past decade no longer hold. The 50 million ounce shortage is not Samsung's problem alone. It is the leading edge of a global materials crisis that has been building silently while the world focused on chip shortages and pandemic disruptions. And it is only now becoming visible because someone decided a recording needed to be disclosed. The question is no longer whether there is a shortage. The question is what happens when shortages of this scale become permanent. There's a number that commodity traders watch with the intensity of cardiac surgeons monitoring a patient's vital signs. That number is registered inventory. Specifically, the registered inventory sitting in COMEX approved warehouses available for immediate physical delivery. When that number falls below 10 million ounces, experienced traders start making phone calls. When it falls below 7 million, they start repositioning portfolios. When it hits 5 million, as the Samsung CEO's recording indicated, they start questioning whether the market itself still functions the way textbooks say it should. COMEX is not a warehouse. It is a marketplace where contracts are traded, where prices are discovered, and where the financial world decides what silver is worth. Most contracts never result in physical delivery. They are settled in cash. A trader in London buys a contract. A hedge fund in New York sells one. Money changes hands, but metal never moves. This works perfectly well, as long as everyone believes that physical metal could be delivered if anyone actually demanded it. The system runs on confidence. Confidence that behind the paper contracts, there is real silver sitting in real vaults, ready to be shipped to anyone who asks for it. 5 million ounces means that confidence is being tested. To understand why, consider what registered inventory actually represents. These are not theoretical ounces. These are physical bars sitting in warehouses in New York, weighing approximately 1,000 ounces each. They have serial numbers. They have been assayed and certified. They are ready to be loaded onto trucks and delivered to whoever holds the contract demanding delivery. 5 million ounces equals roughly 5,000 bars. In a market where daily trading volume can exceed 200 million ounces in paper contracts, 5 million in physical inventory is not a comfortable margin. 10 years ago, COMEX registered silver inventories averaged between 40 and 60 million ounces. There was cushion. There was buffer. If a major manufacturer like Samsung needed to take physical delivery of 10 million ounces, the market could absorb it without panic. What happened to the other 55 million ounces? They were delivered. They left the warehouses and went to manufacturers who needed physical metal for production. Every ounce that departed represented real industrial demand that could not be satisfied through existing supply chains. Every ounce that left made the remaining inventory more valuable and more critical to market stability. Here is what most people do not understand about commodity exchanges. They exist to provide two things: price transparency and delivery assurance. When inventories are healthy, both functions work smoothly. Buyers and sellers agree on prices based on supply and demand signals. Industrial users know they can acquire physical metal when needed, but when inventories collapse, the exchange stops being a neutral marketplace and becomes a battleground. Industrial users who need metal compete against financial traders who are short contracts and suddenly realize they might be forced to deliver metal they do not have. This is called a squeeze. Not the dramatic kind that makes headlines, but the slow, grinding kind where spot prices decouple from futures prices, where premiums for physical metal above paper prices expand from 2% to 5% to 10%. Where manufacturers like Samsung discover that the price they see quoted on financial terminals is not the price they actually pay when they need metal delivered to their factories. The 5 million ounce figure represents more than low inventory. It represents the point where COMEX stops being a reliable indicator of silver availability and starts being a warning signal that the physical market has separated from the paper market. When Samsung's CEO mentions this number in a disclosed recording, he is not commenting on commodity market technicalities. He is stating that the mechanism his company relies on to acquire essential materials is failing. Other markets have experienced this before. In 2008, rhodium inventories collapsed and prices spiked from $2,000 per ounce to over $10,000 in months. In 1980, silver itself experienced a dramatic squeeze when the Hunt brothers attempted to corner the market. But those were driven by speculation and manipulation. What is happening now is different. This is driven by genuine industrial demand exceeding available supply, while financial markets continue trading as if nothing has changed. Exchanges are designed to handle normal market conditions. They are not designed to handle sustained structural deficits, where industrial consumption permanently exceeds mining production. When that happens, inventories do not stabilize. They continue falling until either prices rise high enough to destroy demand or production increases enough to restore balance. Or the exchange itself becomes irrelevant because all physical metal trades outside official channels at prices that bear no relationship to published quotes. Samsung's procurement team understands this. They have watched inventories fall month after month. They have seen premiums rise. They have experienced delayed deliveries and failed contracts. The 50 million ounce shortage and the 5 million ounce COMEX inventory are two sides of the same crisis. One represents what Samsung cannot find. The other represents what the entire market is fighting over. And when the vaults are nearly empty, the fighting becomes serious. When a disclosed recording reveals that one of the world's most sophisticated manufacturers is facing a 50 million ounce shortage while exchange inventories sit at 5 million, the appropriate response is not panic. It is recalibration. Business leaders across industries must now operate under a different set of assumptions than those that guided decisions for the past 2 decades. The era of abundant materials at stable prices has ended. What comes next requires strategies that most MBA programs do not teach, and most corporate procurement departments are not built to execute. The first strategic question is direct. Does my business depend on materials that are becoming scarce? For technology manufacturers, the answer is obvious. For automotive companies transitioning to electric vehicles, the answer is yes. For renewable energy developers, yes. For defense contractors, yes. For telecommunications infrastructure providers, yes. But the exposure extends further than most executives realize. Silver is used in medical devices, water purification systems, RFID tags, solar panels on commercial buildings, and countless industrial applications that never appear in consumer marketing. Any company whose supply chain intersects with electronics, energy, or advanced manufacturing is exposed. The second question is more difficult. What is the timeline? Shortages do not announce themselves with clear deadlines. They emerge gradually as lead times extend, as suppliers request prepayment, as spot prices diverge from contract prices, as procurement teams report difficulty securing commitments for next quarter's orders. By the time a CEO is discussing shortages on a recording, the timeline is immediate. Samsung is not warning about risks that might materialize in 3 years. They are managing shortages that are affecting production now. Business leaders must understand that traditional procurement strategies no longer provide security. Just-in-time inventory management assumes reliable supply. It assumes that materials can be ordered when needed and delivered within predictable timeframes. That assumption is now dangerous. Companies that maintained lean inventories to optimize working capital are discovering that capital efficiency means nothing when production lines stop because critical materials are unavailable. The strategic response begins with inventory policy. Businesses that can afford to hold 3 to 6 months of critical materials, inventory should do so immediately. This is not hoarding. This is risk management. When supply chains are fragile and exchange inventories are depleted, the company that secured materials 6 months ago has a competitive advantage over the company that assumed supplies would always be available. Financial analysts may question the capital tied up in inventory. Operations teams may resist the storage and management costs. But executives must weigh those concerns against the cost of production shutdowns and lost market share when competitors who secured supply continue operating while others cannot. Long-term contracts must be restructured. The standard procurement approach of negotiating annual contracts with price adjustments based on market indices no longer reflects reality. Suppliers who have limited metal are prioritizing customers who commit to multi-year agreements with volume guarantees and price floors that protect the supplier from market volatility. Samsung's shortage exists partly because spot market purchases cannot fill gaps when contract suppliers cannot deliver. Businesses must shift from transactional purchasing to strategic partnerships with suppliers, even if that means paying premium prices for supply security. Vertical integration becomes relevant again. For decades, manufacturers outsourced raw material sourcing to focus on core competencies. That strategy worked when materials were abundant. Now, companies with direct relationships to mining operations or refining facilities have structural advantages. Tesla invested in lithium mining partnerships. Apple secured cobalt supplies through direct agreements. The same logic applies to silver and other critical materials. Businesses large enough to invest in upstream supply chains should evaluate whether securing raw material access provides strategic value beyond cost savings. Alternative materials research must accelerate. Engineers have known for years that silver's unique properties, its electrical conductivity, thermal conductivity, and antimicrobial characteristics, make it difficult to replace in many applications. But difficult is not impossible. When materials become scarce and expensive, innovation accelerates. Companies should fund research into silver reduction technologies, alternative materials, and product redesigns that maintain performance while using less of constrained inputs. This is not a short-term solution, but it positions businesses to adapt as scarcity intensifies. Financial hedging strategies require reassessment. Most companies do not hedge commodity exposure beyond fuel and basic materials, but when critical inputs face structural shortages, price volatility becomes an operational risk, not just a financial one. Businesses should consult with commodity specialists about forward contracts, options, and other instruments that provide price certainty even if they do not guarantee physical delivery. The goal is not speculation. The goal is protecting margins and budgets from price spikes that could make products unprofitable or uncompetitive. Geopolitical considerations cannot be ignored. Silver mining is concentrated in specific countries. Refining capacity is concentrated in others. Trade policies, export restrictions, and national security concerns increasingly influence commodity flows. China controls significant refining capacity. Mexico is the world's largest silver producer. Any disruption to political relationships or trade agreements affects supply availability. Businesses must diversify supplier geography and monitor policy changes that could restrict access to critical materials. The disclosed Samsung recording is not an isolated incident. It is a signal that material constraints are moving from theoretical risks discussed in strategic planning sessions to operational realities affecting production today. Business leaders who recognize this signal and act on it will navigate the coming years with advantages their competitors lack. Those who dismiss it as temporary volatility or someone else's problem will find themselves negotiating from positions of weakness when materials they need are controlled by others who planned ahead. The global economy is entering a period where access to critical materials determines competitive position as much as technology, talent, or capital. Samsung's 50 million ounce shortage and COMEX's 5 million ounce inventory are not anomalies. They are the new baseline. And the businesses that adapt to this baseline will be the ones still operating when others are explaining to shareholders why production targets were missed and market share was lost. The recording was disclosed for a reason. The question is whether business leaders are listening.